Ladies and gentlemen, welcome back to another episode of Boss Economics World. Today, we're slicing through all the hoopla surrounding last week's headline-grabbing gold price drop following what was a massive surge over the past 20 months. It's chaos, right? 1 minute, gold is celebrated like the star of the show, surging up 6% on geopolitical tensions. The next, it tumbles by 2%. What's going on? Well, hold your breath, folks. It looks like we've got a tangled mess of weak dollar, the Federal Reserve looming large, uncertain interest rates, and geopolitical volatility. Just the thing you'd expect from an economy that's lurching from one crisis to another. So, today we're going to break down what's truly happening behind the scenes, explaining it from point to surface, exposing the root causes of this turbulence in gold prices, forecasting what to expect, and, of course, dishing out a healthy dose of satirical criticism about the way global economic policy, particularly the Fed, is propelling us all into an economic downturn. Grab your coffee, and buckle up, because this ride isn't for the faint of heart. Let's start with gold, the so-called safe haven asset. Historically, when the world looks uncertain, wars happen, or economies appear shaky, the smart money jumps into gold. People trust it. But not this past week, oh no. Despite a declining US dollar, usually a factor that helps boost gold because it makes the shiny metal cheaper for foreign buyers, gold prices dropped 2% to dip below $2,700 an ounce. Why? One word, the Federal Reserve. Markets are nervously eyeing the Fed's upcoming interest rate decision like it's the sword of Damocles hanging over their heads. And let's be real here, if you're watching the Fed as closely as we are, and trust me, we should, you know that this group of economy warriors loves to fiddle with the levers of interest rates, especially when inflation data on the horizon keeps messing up their televised scripts. The latest data shows business activity in the US expanding at the fastest rate since April 2022. So what does that mean? It's another headache for Jerome Powell and his merry band at the Federal Open Market Committee, FOMC. Swaps traders are still pricing in less than a 50% chance of a rate cut next month. And why is that important for gold? Well, because gold, quite simply, doesn't pay interest. High interest rates make holding gold a lot less appealing compared to bonds or even growing piles of cash. As Jun Rong Yeep from IG Asia PTE judicially stated, the interplay between geopolitical risks and a less dovish outlook from the Federal Reserve is keeping gold prices on their toes. The Fed is inching towards rate holds or future cuts being at a slower pace, which means rate hikes might be off the table for now, but also, don't place your bets on looser monetary policy just yet. Let's get real for a moment. The Fed's cautious stance is becoming its own form of geopolitical risk. They're trying to appear calm, while the economy underneath them is like a house of cards teetering in the wind. And this indecision is playing havoc with gold, which is supposed to be a stable store of wealth. Yeah, right. Figures released this week hint we're likely entering a period where inflation once again surprises markets. The Personal Consumption Expenditure Report, their preferred inflation tracker, signals persistent underlying inflation pressures, hinting that rate cuts could come slower than expected. So, the road ahead for gold looks uncertain, which is a bit ironic considering it's the haven asset people run to for, well, certainty in uncertain times. While the Federal Reserve plays its confusing game of whether to cut or not to cut rates, gold did briefly enjoy a strong surge, buoyed by none other than geopolitical chaos. Just as we were waking up to what seemed like another round of bad news in the ongoing Russia-Ukraine war, gold bulls charged forward with a rally that saw prices spike. Last week alone, amid rising tensions, gold rallied by 6%. This is classic behavior. When the world turns scary, people rush to safety, and gold has historically been that safe haven. This brings us to the other major reason gold surged in the first place. The world is no calmer today than it was yesterday. Central banks, especially those in emerging markets, have been stocking up on gold like it's going out of style. In 2023, central bank gold purchases hit record highs, with many countries seeking the precious metal as a hedge not only against inflation but against growing geopolitical risks. You guessed it, conflicts like Russia-Ukraine mean many countries want to diversify away from the US dollar-dominated system and hedge against further economic and political instability. It's like they're saying, we don't trust the global financial system anymore, let's hold something that's universally valuable. And while the general public doesn't always notice it, gold ownership by central banks is a sign of eroding confidence in the existing global order. The Fed may be stuck in its complicated ballet with interest rates, but there's another story unfolding here that's worth noting: growing concerns about a broader breakdown in global coherence. Tensions between world powers, supply chain disruptions from China, and economic decoupling trends are all pushing demand for gold higher over the long term. Geopolitical instability plus central bank uncertainty equals long-term gold upside? Seems like a pretty straightforward equation to me. Now, here's where things get even juicier. Even when the US dollar slid dramatically this past week, gold still took a beating. Now, wait a minute. The usual script goes something like this: dollar goes down, gold goes up. Partly because a weakening dollar makes gold cheaper for everyone else. But nope, that didn't happen this time. On Monday, the US dollar index dropped by 0.5%, and there was a decline in the 10-year US bond yields too. This would typically be champagne time for gold traders, it should have rallied along with other commodities. But instead, gold prices retreated. Something's wrong when the usual correlations don't apply, right? That's where we bring in our unlikely central character, US policy uncertainty, ushered in on a high by none other than the president-elect's new pick for Treasury Secretary, hedge fund manager Scott Bessent. There's a growing expectation that Scott Bessent will prioritize economic stability, possibly an attempt to restore normalcy to markets still groggy after years of erratic fiscal policies. In a way, markets now are finding a middle ground between expectations of fiscal stability and being prepared for Trump's perennial unpredictability, which probably puts pressure on gold's near-term prospects. And make no mistake, nobody watches these shifts closer than central banks, pension funds, and hedge funds. But remember why this is ironic. The Fed, designed to provide stability, instead is the one source of uncertainty driving all these knee-jerk responses. Oh, the paradox. But there's an elephant in the room, global recession risks. Sure, right now it's all about central banks timing interest rate pivots and geopolitical flashpoints pushing commodities. But what happens when the whole global economy feels a slowdown? With Europe's economy barely limping forward, China's growth engine sputtering thanks to its ongoing property market crisis, and the US looking at distorted yield curves signaling possible recession, the whole world may be barreling toward slower growth. Historically, recessionary periods are gold's time to shine even brighter because it hedges against both inflation and economic downturns. So the question becomes this: how long can the Fed keep juggling these rate decisions before the underlying economy takes a sharp turn south? Many major banks like Goldman Sachs and UBS remain relatively bullish on gold's medium-term prospects, predicting higher prices in 2025. Whether this prediction holds depends heavily on how prolonged and deep the next economic slowdown will be. If the recession bites, wages stagnate, and unemployment rises, look for that data in Q1/Q2 of 2024, gold will likely find a steady floor for demand. So, what has broader economic management got to do with all this? I mean, the government painted a calm picture, more employment, business activity recovering. But when you dig deeper into the numbers, what we're seeing is an economy on cruise control, but dangerously close to running out of gas. The federal debt keeps ballooning, inflation continues to rage, and global banks' gold by hoarding is telling us one thing: nobody really trusts that these so-called leaders know what they're doing. Let's be blunt here. There's plenty of talk about technicals like yield curves and inflation swaps. But the fundamental problem is that governments and central banks worldwide have been playing a game show with economic fundamentals. Things like the relentless surge in asset prices, driven mostly by cheap money, and artificially low rates should have caused a reckoning long ago. Yet here we are. As professionals and even armchair economists, we can't afford to ignore the systemic risks our leaders conveniently forget to mention in their televised speeches. A lot of blame can be placed on central banks and government policies that have steered economies into dangerous territory over the last decade. Take a look at the Fed, the European Central Bank, ECB, and even the Bank of Japan. What they've done is unleash cheap money into the system, inflating asset bubbles in housing, equities, and even crypto. This isn't investment based on fundamentals but on speculation fueled by easy money. But here's the punchline: these bad decisions are now coming home to roost. The staggering debt levels, both public and private, aren't sustainable, and it's getting harder to ignore the cracks that are forming. Central banks toyed with low-interest policies for too long, thinking they could navigate a soft landing out of these peculiar times. But instead, what they've created is a fragile economy where the slightest uptick in interest rates, or any external shock, could bring the whole house crashing down. The truth nobody wants to admit is that the global economy is now teetering on a debt time bomb. The world, led by so-called financially responsible countries like the US, has been gorging on debt. Total global debt surged past $305 trillion in 2023, up from $255 trillion just a few years earlier. Governments have racked up debt printing money in an attempt to paper over slow growth, while corporations, fueled by record low interest rates, have been borrowing like there's no tomorrow to fund share buybacks and speculative investments. Let's look specifically at the United States. The U.S. national debt rocketed above $33 trillion by the end of 2023, an unimaginable figure, and it's continuing at an accelerated pace under fiscal policies that show no sign of tightening. What does this mean? More and more tax revenue will have to go toward merely servicing that debt, turning the national budget into a Sisyphean task. The debt-to-GDP ratio in the U.S. now hovers at 125%, which essentially means the country owes more than it produces annually. That's catastrophic in the long term. And it's not just America. Japan has a debt-to-GDP ratio of about 260%, while Europe, China, and emerging markets are all bloated on debt. This debt pile is manageable when interest rates are near zero. But what happens when inflation starts running wild as it did in 2022 and 2023, and central banks are forced to raise rates? Suddenly, the cost of servicing this debt soars, and governments find themselves on borrowed time. Imagine you live paycheck to paycheck, financing your lifestyle with credit cards. You might get by if interest is low, but if those rates start climbing, you're in trouble. This is the exact situation for entire nations right now. Governments and central banks are cornered because they've promoted debt-based growth for so long that raising rates or tightening fiscal policy suddenly becomes borderline impossible without triggering a recession. So they're trapped. That's why rate policy and inflation expectations make gold such a key player in today's economy, because as this house of cards falters, gold offers a much-needed anchor, a hedge against both inflation and the systemic risks that touch every corner of the financial system. The mismanagement of economic policy isn't exclusive to the US. We have a global situation where all the major economies of the world are in trouble. Let's break it down. China has long been the poster child for rapid economic growth, but that growth is now running into real challenges. The country's property market is in shambles, with real estate giants like Evergrande and Country Garden teetering on the edge of default. Real estate accounts for about 30% of China's GDP, and this sector is now facing a harsh reality, a bursting bubble that could reduce the broader economy's momentum. Chinese youth unemployment is also hitting record highs, exceeding 20% in urban areas. With such instability, it's no wonder Beijing's leadership is scrambling to create economic stimulus initiatives. But these stimulus measures are not having the same kick as they did in the post-2008 era. China's pivot to a consumer-driven economy hasn't materialized yet, and its once reliable export-driven growth model is faltering amid geopolitical tensions and trade barriers from the West. Adding to that, China has been a massive buyer of gold throughout 2023, with significant purchases by its central bank, reinforcing its strategy of decreasing reliance on the US dollar. This is an indication that not even China trusts the current global economic system, so they're hedging their bets just as everyone else is. Meanwhile, Europe remains embroiled in its own economic travails, mostly revolving around Germany and France, the Eurozone's two primary pillars. German industrial output is contracting, and they are facing their worst manufacturing slump since 2008. France isn't much better. With strikes, social unrest, and chronic underemployment, the entire Eurozone is softening into economic stagnation. The ECB's response is tied up with its own hike-tighten loop, like a tune no investor enjoys hearing. The irony is that Europe, with all its internal divisions and lack of cohesive fiscal action post-Brexit, continues to shuffle along almost directionless. Inflation across the Eurozone remains well above their 2% target, making any aggressive QE policies difficult without stoking prices further. The US right now looks, on the surface, like the economy is stable, maybe even healthy. You've got Treasury yields adjusting down, business activity climbing, and relatively low interest rates, but beneath the surface, it's a disaster waiting to happen. Wage growth in the US lagged behind inflation for much of 2023, which means real incomes for middle-class families have eroded. Sure, official data says inflation is cooling off, it's down from the 40-year highs of 2023, but it's unclear whether that's a trend or just a temporary dip. From the tech sector to consumer discretionary spending, we're seeing warning signs of slackening growth. With inflation biting and the Federal Reserve engaging in its higher-for-longer strategy on interest rates, concerns are mounting. How much can the consumer bear? When does consumer sentiment crater? Not to mention the U.S. housing market. Even after years of skyrocketing house prices, in 2023, higher mortgage rates put home ownership out of reach for millions of Americans. Home sales plummeted. But unlike 2008, this isn't a situation driven by subprime loans, it's simply high prices meeting higher interest rates, with affordability choking the market. A housing slowdown is another signal of weakening economic growth. So, taking all this into account, what does it mean for gold? Through all of the bumps, dips, and surges in prices, gold retains its cliffside view of the entire macroeconomic landscape. Gold is still up more than 25% this year, and many banks, like Goldman Sachs and UBS, predict continuing gains through to 2025. At the heart of those predictions lies one central theme: systemic risk. And not just simple inflation, although that remains a core problem, but total systemic economic and financial uncertainty. Central banks can print money, and they can have intervened in currency markets. But the truth remains that trust is eroding in the US dollar-based global financial system, and gold is being increasingly called upon to back institutional reserves, mitigate inflation risks, and hedge against outright political instability. So what's the real reason this all feels so fragile? Mainstream media and the government will assure you everything is fine, just minor bumps in the road. But the reality is we've been lulled into this sense of normalcy by bad policy and economic misdirection, playing out slowly, year after year. Don't forget what 2023's hottest buzzword was, de-dollarization. The global retrenchment from reliance on the US dollar is underway, with countries like Russia, China, and even Middle Eastern countries seeking alternatives. What started with small murmurs of countries trading in local currencies, remember the Brazil-China trade pact in yuan, has blossomed into a broader distrust of the world economy's reliance on the US dollar. As confidence continues to wane, expect the movement toward alternative currencies and stable, tangible assets to grow. Gold benefits in two key ways. As fiat currencies weaken, gold's value grows stronger, and as investors anticipate market volatility, they turn to gold to preserve wealth. Gold, in this case, is more than a commodity, it's cash under the mattress in a world with fraying economic stability. In the growing uncertainty of today's economic environment, we should all be paying attention. The decline in gold prices this week, amid the backdrop of the Fed and the falling US dollar, highlights just how precarious things are. As much as governments and institutions want you to believe the economy is improving, the truth on the ground says otherwise. A deep economic malaise, driven by mismanaged monetary policy, mountains of debt, the prospect of a global slowdown, and the continued weaponization of currencies, shows that our current systems aren't working. Channeling our inner, boss economics world, let's make it clear, it's time we pull off the blinders and look at what's developing behind the shiny projections of growth.